Enbridge Inc. is a Canadian energy infrastructure company headquartered in Calgary, Alberta. Founded in 1949 as the Interprovincial Pipeline Company, it has grown into North America's largest liquid pipeline operator and a major gas transmission and utility provider with extensive renewable energy assets. Enbridge operates across 4 core business segments: liquids pipelines, gas transmission, gas distribution and storage utilities, and renewable power generation. It delivers roughly 3 million barrels of oil per day via its crude liquids pipelines and transports about 20% of natural gas consumed in the United States. The company also distributes natural gas across Ontario and Quebec through millions of customer connections, owns extensive underground storage systems, and is the largest gas utility operator in North America. Its renewable footprint includes multiple wind and solar farms primarily in Canada, the United States, Germany, and France. Enbridge's financial model is distinguished by highly regulated or contracted revenue streams. Approximately 98% of its EBITDA originates from take-or-pay or inflation-indexed contracts, buffering it from commodity price volatility. Its business generates predictable cash flows and allows for consistent dividend growth. For full fiscal year 2024, Enbridge reported adjusted EBITDA of approximately 18.6 billion Canadian dollars, a 13% increase versus prior year. Distributable cash flow reached 12.0 billion Canadian dollars, up 6% year over year. GAAP earnings attributable to common shareholders were around 5.1 billion Canadian dollars, or 2.34 per share, slightly below the prior year's 5.8 billion or 2.84 per share due to certain non-operating impacts. Cash provided by operating activities totaled 12.6 billion Canadian dollars. Adjusted EBITDA and distributable cash flow per share both improved modestly, reflecting both higher earnings and the impact of incremental share issuance to fund acquisitions. Enbridge reaffirmed its 2025 guidance with adjusted EBITDA between 19.4 and 20.0 billion Canadian dollars and distributable cash flow per share in the range of 5.50 to 5.90 Canadian dollars. This guidance implies growth of roughly 9% in EBITDA and approximately 3% in DCF per share versus 2024. Enbridge projects its near-term growth from 2023 to 2026 at 7 to 9% EBITDA, 4 to 6% EPS, and 3% DCF per share. Beyond 2026, it expects approximately 5% annual growth in all 3 metrics. One of the most meaningful recent developments is the completion of its acquisition of 3 U.S. natural gas utilities from Dominion Energy, valued at approximately $14 billion including assumed debt. This move established Enbridge as the continent's largest gas utility operator. The purchase significantly strengthens its regulated utility footprint and enhances its distribution scale across key U.S. markets. The firm also closed the acquisition of additional docks adjacent to its marine terminal for a few $100 million and has backed multiple organic growth projects, including a large solar farm in Texas, Sequoia Solar, and expansion of its Fox Squirrel Solar project in PJM region. Enbridge's secured growth backlog now stands at approximately 26 to 28 billion dollars, which includes projects already contracted or under construction. It continues to execute organic growth investments and has placed about $5 billion of projects into service in 2024 and added another $8 billion into the secured backlog. On the dividend front, Enbridge has increased its quarterly common share dividend for 30 consecutive years, delivering resilient yield performance. In early 2025, it announced a 3% increase, raising the annual dividend to 3.77 Canadian dollars per share, or approximately 0.9425 per quarter. This marks the 30th consecutive annual increase. The dividend yield currently stands near 6 to 6.25%, making it one of the highest yield offerings among North American utilities and infrastructure names. Management is led by CEO Greg Ebel and CFO Pat Murray. Leadership emphasizes financial discipline, predictable capital allocation, and disciplined balance sheet management. The company targets a conservative net debt to EBITDA ratio between 4.5x and 5.0x, maintaining strong liquidity and sufficient investment capacity. Financing includes $2.8 billion in senior note issuance in 2025 to replace maturing debt and fund capital expenditures, while growth capital remains self-funded through a mix of cash flow and occasional equity issuance. Enbridge's emphasis on regulated cash flow and disciplined capital deployment supports its ability to sustain dividends and fund high-quality infrastructure. Competition in the pipeline and utility sector includes Western Midstream Partners, MPLX, Hess Midstream, Kinder Morgan, TC Energy, and US utility operators. Enbridge generally enjoys scale advantages, stronger geographic footprint across Canada and the US, and diversified business lines. It remains dominant in oil pipeline tolling and increasingly significant in gas distribution and renewables. Few competitors match its size or regulated cash flow profile, particularly given Enbridge's scale in renewable generation and North American utility reach. Peer benchmarking reveals that Enbridge trades at valuation multiples consistent with its utility-like stable cash flows. Its forward price-to-earnings ratio is typically around 18 to 20, often similar or slightly higher than other midstream peers. Its distributable cash flow payout ratio remains within its target range of 60 to 70%, considered sustainable given the cash flow stability. Debt structures and financing needs remain manageable at targeted leverage ratios. A discounted cash flow valuation model for Enbridge assumes mid-cycle distributable cash flow growth of 3 to 5% beyond tax AGJ rates, a terminal growth rate near 2%, and a weighted average cost of capital around 8 to 9%. Under these assumptions, fair value estimate per share lies in the mid-40s range in US dollars or high 40s to low 50s per share in Canadian dollars. More aggressive growth or lower discount rate assumptions push fair value toward the upper 50s in Canadian dollars. Conversely, conservative scenarios with higher discount rates and slower growth suggest fair values closer to 40 Canadian dollars. On the technical side, Enbridge shares have recently shown moderate strength, with a relative strength rating in the low 70s on a scale where top-performing stocks are 80 and above. The stock typically trades in a range between 40 to 50 Canadian dollars. Support commonly resides around 40 Canadian dollars, while resistance hovers near 48 to 50 Canadian dollars. The moving averages show mixed sentiment. The 50-day line may be flat, while the 200-day average remains upward sloping, signaling consolidation rather than a breakout. Investors watching for formation of clearer buy areas or chart patterns such as cup base or break above 50 should exercise patience. Investment recommendations depend on investor objectives. For ultra-conservative income investors seeking secure dividends, Enbridge is compelling at current yields around 6%, supported by long-term visibility on DCF and regulated operations. These investors may view fair value as being in the low 40s Canadian dollars, making current prices an opportunity to buy or hold. Growth investors or ESG-oriented investors may focus on Enbridge's renewable expansion and US utility integration, which could support valuations in the upper 40s to low 50s range if execution proceeds smoothly. Those with cyclically sensitive outlooks, concerned about interest rate risk, regulatory headwinds, or capital spending flexibility might wait for pullbacks toward midpoint of range or signs of deleveraging before committing. In summary, Enbridge is a large-scale, regulated energy infrastructure company generating dependable cash flows with diversified assets in pipelines, utilities, and renewables. It maintains a long track record of dividend growth, robust financial discipline, and growing utility scale. Its 2025 guidance reflects modest yet predictable growth, and its recent acquisitions and organic projects support low-risk expansion. Valuation models suggest fair value in the low to mid-40s in Canadian dollars per share, with upside potential if renewable projects or utility integration outperform. For dividend-focused investors, it remains a top pick in yield, while growth investors must weigh the premium multiple against energy transition opportunities and execution risk.